Welcome back. Today, we're doing a deep dive into a really unusual moment in corporate history. We're looking at the Morgan Stanley Shareholders Letter from April 2020. Just think about that timing for a second. April 2020. The world is basically hitting pause because of COVID-19, and yet this letter has this incredible balancing act to perform. It has to celebrate 2019, which was, a record-smashing year for them, one of their best ever. But at the same time, it has to face this immediate, frankly terrifying reality of a global pandemic and, well, an economic meltdown. The whiplash must have been something else. So our goal here is to give you a shortcut, really, to understanding how a giant financial institution like Morgan Stanley tries to pivot, tries to manage its strategy and operations when it's under just extreme pressure. We want to unpack the big bets they placed right before everything changed and look at the key promises they made right there in the thick of the chaos in April 2020.
Yeah, and what's really striking about this letter is that the chairman doesn't just gloss over the crisis. Not at all. It opens with real concern, immediately shifting from, the usual financial highlights to the human cost, acknowledging the loss of life, the economic devastation hitting people, mentioning the surge in unemployment specifically, and the need for significant stimulus measures worldwide. This wasn't your standard shareholder update. It felt more like, well, battlefield triage wrapped around a victory lap for the previous year.
Okay, so let's start right there with the triage. Operationally, what did they actually do when the crisis hit? How did they keep the lights on, essentially, when everyone was being sent home?
Well, fundamentally, they leaned very heavily on past investments, big investments in technology, and also really detailed business continuity planning. The letter makes a point of saying that about 90% of their workforce, that's over 60,000 people, managed to switch to working from home, instantly. And that capability was crucial for letting them keep global markets operating without major disruptions on their end.
And you have to remember, this wasn't like the smooth work from home we might think of now. This was early days, people scrambling, internet issues, yet the core functions, the market making, kept going. That operational strength must have saved them huge reputational headaches.
Absolutely. And underpinning that operational side was a really remarkable promise they made, something that went way beyond just technology. The firm's operating committee went public with a commitment to all staff. Their jobs were safe through the end of 2020. They explicitly promised no reduction in force.
Wow, that's a massive promise when you think about what was happening elsewhere. Companies were shedding jobs left and right. Why make that promise? Was it just good PR, or was there a deeper strategic reason?
Well, it was definitely strategic, much more than PR. It was about retaining their key people, their talent, and reinforcing the company culture during maximum uncertainty. Think about it. When markets are that volatile, stability, especially job security, is how you keep your best performers from jumping ship or just freezing up. By guaranteeing jobs, they were signaling massive confidence in their own financial position and their strategy. It turned an internal HR decision into, really, a public statement of strength.
Okay, and speaking of strength, their financial position. How did they talk about themselves in relation to the wider financial system? Were they just trying to survive, or were they aiming higher?
They were definitely aiming higher. They made a very clear point that the financial system itself was much, much stronger than it had been in past crises, specifically pointing to all the reforms made after 2008. The firm stated, quite confidently, that they had the capital, the liquidity needed to actually help stabilize markets, working alongside governments and central banks. They weren't just weathering the storm, they were positioning themselves as a key part of the eventual recovery effort.
Right, and that confidence, that ability to promise no layoffs, it all had to be built on how incredibly well they did in 2019, didn't it? Before the world turned upside down, 2019 was just huge for them. What were some of the standout numbers from that year?
Oh, 2019 was definitely a peak, no doubt about it.
Yeah.
They hit record annual revenues over $41 billion, plus record pre-tax profit and record net income. And they showed consistency, too, hitting over $10 billion in revenue for 4 straight quarters. That kind of reliable performance is key.
And the big efficiency number that shareholders always look at, the return on average tangible common equity, the ROTCE.
Yes, the ROTCE. For 2019, it came in at 12.9%, which, for anyone tracking, hitting nearly 13% put them squarely within their target range. It meant they were generating good value for shareholders before the crisis hit. And this wasn't just one part of the business firing on all cylinders. It was the combination, the complementary franchises, as they call them, institutional securities, wealth management, and investment management, all contributing.
Let's dig into the institutional securities bit first, the sort of traditional investment banking arm. How was that performing?
It was really dominant. They were leveraging their scale effectively, #1 globally, and equity sales and trading revenue share, and that was for the 6th year running. Plus, they were consistently in the top 3 globally for M&A advisory and for IPO underwriting. That kind of leadership in core banking activities generates very significant, often reliable fees.
Which leads us nicely into the bigger strategic picture, right? Because that fantastic 2019 wasn't just luck. It was the result of a strategy they've been working on for, what, a decade? This whole shift towards durable sources of revenues. Let's unpack that.
Exactly. That's probably the core lesson here for you listening. Strategic planning really paid off in 2020. This wasn't a sudden reaction. It was a long-term pivot, going back to decisions made after the '08 crisis, like selling off riskier parts of the business to deliberately reduce their reliance on volatile trading income. They consciously rebuilt the business mix to be less vulnerable to market shocks.
So what does durable actually mean in their context? What kinds of revenues are we talking about that don't just evaporate when markets tank?
Primarily, its revenues coming from 3 main buckets.
Mm-hmm.
Fee-based pricing, things like asset management fees where you get paid on the assets you manage. Second, financing and lending, basically, earning interest income. And third, investment banking advisory services fees for advice on M&A and things like that. The common thread is that these businesses tend to rely more on long-term client relationships and sticky assets rather than just daily market swings.
And what was the payoff? How much did this defensive posture actually contribute before the 2020 storm hit?
It provided massive stability. The letter states these durable sources made up well over half of the entire firm's revenues in both 2018 and 2019. So when the really volatile parts of the market, like certain trading areas, took a nosedive in March 2020, Morgan Stanley already had this significant cushion, a baseline of profit and cash flow that was less affected. It really blunted the impact of the crash for them.
And that underlying stability must be why they felt confident enough to actually reiterate their future financial targets, even in April 2020. They were still talking about their 2021 goals, aiming for that ROTCE to expand further to 13%, 15%, and hitting a really tight expense efficiency ratio target of 70%, 72%.
Right, that confidence is key.
Mm-hmm.
And that efficiency ratio target, it basically means they believe that for every dollar they brought in, they could keep their operating costs down to just 70 or 72 cents. Sticking to that target suggested they felt the investments they'd made in scale and technology, the very things that enabled mass work from home, would actually make them more efficient going forward, despite the disruption.
Okay, let's pivot now to what was arguably the biggest, boldest strategic move they made just weeks, literally weeks before the world shut down, announcing the plan to buy E-Trade in February 2020. I mean, the timing. It felt either incredibly prescient or potentially disastrous.
It was a massive gamble, designed to completely reshape their wealth management division. Now, wealth management was already a powerhouse for them. It brought in over $17 billion in revenue in 2019, with a really healthy pre-tax profit margin of 27.2%. But E-Trade was seen as the missing piece.
And the logic was about dominating across different types of clients, right? They talk about these 3 channels. Can you break down how E-Trade fit into that?
Sure. The 3 channels are the traditional financial advisor model for high net worth clients, the full service channel, the workplace channel, services offered through employers, and the self-directed channel, digital platforms for individuals. Morgan Stanley obviously had the high-end advisor piece covered. E-Trade brought enormous scale and capability in that third bucket, the direct-to-consumer, self-directed digital space.
But the really clever bit seems to be how it connected with the workplace channel, especially linking back to an earlier acquisition they made, Solium, which became ShareWorks.
It's exactly right. ShareWorks manages company stock plans and benefits programs for employees. So think employee stock options, restricted stock units, that kind of thing. By bolting E-Trade onto ShareWorks, they created this incredibly powerful offering for companies and their employees. They could use their existing relationships with corporations via institutional securities to offer ShareWorks and then capture those employees' assets and broader financial lives through E-Trade's platform.
Ah, so it's like a funnel.
Yeah.
Use the investment bank to get into the company with ShareWorks.
Mm-hmm.
The employees of that company become potential clients, maybe starting on the E-Trade platform.
Yep, capturing them often earlier in their careers, maybe in the mass affluent segment.
And then as those employees build wealth, maybe through those stock plans, they can be graduated up to the full-service Morgan Stanley advisors.
Precisely. It's a really integrated client acquisition strategy, and they projected this combination would make wealth management even more profitable and stable. They set a target for that division to hit a 28%, 30% pre-tax margin by 2021. It's a huge bet, reinforcing that whole strategy of durable, fee-based, balance sheet-light revenues.
Okay, fascinating. Let's shift gears completely now. Away from the numbers, towards culture, values, societal impact. The letter spends a lot of time talking about things like doing the right thing, giving back. Often in a crisis, that stuff goes out the window first. How did Morgan Stanley try to show this was more than just nice words on paper? What concrete actions did they point to?
Well, they really framed their environmental, social, and governance ESG efforts as being core to their identity as a capital allocator, not just a side project. So on the environmental front, they highlighted a massive commitment to facilitate $250 billion in low-carbon financing by the year 2030. That's funding for things like clean tech and renewable energy.
Wow, $250 billion?
That's hard.
That's a staggering figure. Just for perspective, that's like several times the annual GDP of a small European country. Making that kind of financial pledge, even as the global economy was cratering, that's a statement.
It is. And they added other specifics, like their plastic waste resolution, aiming to help prevent or remove 50 million metric tons of plastic waste by 2030 through financing and advisory work. Plus, internal goals, aiming for carbon neutrality in their own operations by 2022 and getting 100% of their global electricity from renewable sources. Pretty aggressive targets.
It suggests they really believe this stuff isn't separate from financial performance, but actually linked to it long term. They'd already launched their Institute for Sustainable Investing back in 2013, so it wasn't brand new. What about the S in ESG, the social side, diversity, community support?
They directly linked diversity to attracting the best people. They made a point of noting their 2019 summer intern class was majority female, over 50% for the first time ever.
And they have that multicultural innovation lab too, right, to try and tackle the funding gap for diverse entrepreneurs.
Yes, exactly. It's an accelerator specifically designed to back tech-focused startups led by women and multicultural founders. It positions supporting diversity not just as the right thing to do, but also as smart business tapping into new ideas and markets.
And finally, there was that initiative announced literally just before the pandemic stress hit maximum levels, the Alliance for Children's Mental Health.
Yeah, that launched in February 2020. A really timely, perhaps tragically timely initiative. It commits the firm's resources and partnerships with nonprofits to tackle stigma and boost early support for youth mental health. It really underlined that giving back principle by focusing on a crisis that sadly was about to get much, much worse for young people everywhere. So if we pull this all together, this April 2020 letter really is a fascinating case study in, well, corporate resilience under fire. You see this huge financial institution managing an immediate crisis, but able to do things like guarantee jobs and make huge acquisitions because of that decade of strategic groundwork, that relentless focus on building durable revenues, and also having the guts to pull the trigger on something like E-Trade right when the storm clouds were gathering.
Right. So the key takeaway for you listening and thinking about how this applies seems to be that intentional connection they draw between financial strength, operational capability via technology, their core strategy, and these broader cultural and ESG commitments. The bet they're making is that these things aren't trade-off. They're actually interdependent. They all contribute to long-term success and, well, building a business that can withstand shocks. Building a fortress, essentially.
Which leaves us with a really interesting question for you to think about, especially looking back from today. We saw these really ambitious long-term goals laid out carbon neutral by 2022, that huge plastic waste target by 2030. When an immediate existential crisis like COVID hits, do those kinds of long-term societal commitments become a dangerous distraction from just surviving day to day? Or actually, do they become even more vital? Do they help anchor the internal culture, maintain client trust, and provide a sense of purpose precisely because everything else feels so unstable? Something to definitely chew on.